For years, private equity has been painted as the big, bad wolf of the financial world. But what if the real danger isn't the firm that buys the company, but the one that's quietly lending it all that money? Today, we're diving into a question that's got financial regulators on edge. Should we actually be more worried about private credit than private equity? Okay, so let's just break this down. At its heart, the difference is super simple. Private equity firms, they take money from big investors and use it to buy companies outright. The goal is to fix them up and sell them for a profit. Private credit, on the other hand, acts more like a shadow bank. They lend money directly to companies, often the very same ones that private equity just bought. So you've got one that buys and one that lends. Simple enough, right? Well, that is the central mystery we're unpacking. What is it that regulators are seeing that makes them think the lender could actually pose a bigger threat to the entire financial system than the owner? To figure this out, we're going to have to follow the clues, just like a detective story. And our first clue is this thing called the banking daisy chain. It's all about following the money, and when you do, you uncover this hidden and kind of surprising connection between these private lenders and the regular, everyday banks we all know. See, this is the crucial difference. Private equity gets its cash from long-term, patient investors. Think pension funds, university endowments. But private credit, they're often going to big traditional banks and borrowing money themselves. So they have the capital to then go out and lend it to other companies. They are literally borrowing to lend. And this is where that daisy chain idea comes into play. It's a potential domino effect. So picture this. A bank gives a huge line of credit to a private credit fund. The fund then uses that cash to make a loan. But what happens when the economy turns sour and that company can't pay its loan back? Well, the losses slam the private credit fund, which then might have trouble paying back its loan to the bank. And just like that, a problem in the private markets could spill over and become a very real, very public banking problem. Okay, so that brings us to clue number 2. This entire market has become an absolute giant, but it's a giant that's never really been in a serious fight. Just think about this for a second. Since the 2008 financial crisis, this market has just exploded. We're talking trillions of dollars. But that entire period of insane growth has happened during a time of relatively smooth sailing for the economy. It's never been stress tested by a big, nasty, widespread recession where a whole bunch of companies start to fail all at once. So the multi-trillion-dollar question is, what happens when that test finally comes? And that leads to a really crucial, kind of terrifying question that hangs over this whole industry. When things go bad, what do investors do? They run for the exits. They sell. But in the world of private credit, what if there are no exits? And this right here highlights a core weakness. If you own a regular public bond and you get nervous, you can sell it on the market in seconds. Boom, done. You might take a small loss, but you're out. These private loans, though, they're illiquid. There's no open market for them. You can't just click a button and offload it. The fund manager is basically stuck holding this toxic asset, trying to fix a bad loan while the whole world is in crisis mode. All right, our final clue gets right to the heart of what's keeping regulators up at night. Opacity. It's the danger that comes from not really knowing what any of these loans are truly worth, which means you can't know how big the risk is until it's way too late. And this is exactly why people are so worried. Unlike a stock, a private loan doesn't have a price flashing on a screen all day. Its value is decided by the fund manager's own secret internal models. That means losses can be hidden or at least delayed. And then you throw in the rise of these so-called covenant-light loans, and the whole picture gets even foggier. So what in the world is a covenant-light loan? Well, think of it like a loan with way fewer rules. A traditional loan has covenants, which are basically conditions the borrower has to meet. If they break a rule, the lender can step in early. But covenant-light loans, they strip a lot of those protections away. It means a lender might not be able to do a thing until the company is already in deep, deep trouble. Okay, so we've gathered our 3 big clues. Let's assemble them and see if we can get to our final verdict. What is the real risk here that has so many smart people watching this market so closely? It really all boils down to these 3 things. First, you've got that daisy chain linking these private funds directly to our public banking system. Second, you have a massive market that's not only untested in a real crisis, but it's also illiquid. There's no easy escape hatch. And third, this deep lack of transparency, this fogginess that could be hiding a huge storm of losses from everybody. And that third point, the transparency issue, is the one that really seems to worry the experts. As the Alternative Market Guide puts it, This lack of transparency is the real danger here. It could mask the true extent of losses until it is too late. By the time we see the problem, the damage could already be done and spreading. Which really leaves us with one last, kind of sobering thought. With all the attention we pay to the stock market and the giant banks, is it possible that the next big test for our financial system isn't some complex new thing, but is actually hiding in the simple, age-old act of lending, just happening in the shadows where no one can really see?